I want to bring in Michael Shaoul, who helps oversee $10 billion as CEO of Marketfield Asset Management. And Michael, you were actually, unlike the three of us who've been working hard here in the newsroom, you were actually at this event.
I was. Nothing very new from Bill Dudley. He really drove home the point that the Fed is going to be data dependent. And what I like to say about the Fed is it always learns from its last mistake and then makes a new one. So, I mean, one thing they're not going to do is what they did 2004 to 2007, where they set interest rates by the calendar. I think they realized that was a mistake. I think they realized 1994 was a mistake. They're going to put themselves in the hands of the data. And, you know, I think at some point in time, the data is going to make it very difficult for policy.
What's going to be their mistake this time?
I think being so data dependent. I think the danger for Fed policy, if you look at it tied to unemployment and inflation, it's sort of really made that really fairly clear, I think will be in the fourth quarter when the effect of the steep decline in crude oil starts to fall out of all the inflation metrics. And you're almost bound to have a fairly sharp acceleration, in most inflation measures in the fourth quarter, all things being equal. But you know, it's not going to be like it was 2004, 2007. You know, they haven't. You know, to me, they've waited far, far too long to actually do something this cycle, and so. You know, I think we're going to be looking at a cycle dominated by overinvestment, and I think the energy sector's kind of a metaphor for what we see going forwards. That the individual portions of the U.S. economy go through a process of overinvestment. It feels pretty good on the way up. You know, I think a greater proportion of the U.S. economy will move into boom conditions, and then we'll have a cycle dominated by oversupply and overcapacity, and that'll be a little bit tougher.
So do you are you in the are you in the camp of what Jeff Gundlach has repeatedly said, which is he thinks the Fed will make a mistake and that they're going to have to reverse course once they start raising interest rates?
No, I think the whole 1937 thing's overdone. No, I think they should and could have already raised interest rates. Nothing very bad would have happened. I think the mistake they're going to make is they're going to be super patient. They're going to try and avoid 94. They're going to try and help EM. And then what you're going to see, as I say, is something of an overinvestment boom take place in disparate parts of the U.S. economy. You've already had it in energy. You're clearly in the middle of it in an area like biotechnology and other portions of technology. I would argue you're entering it in commercial real estate in several senior cities in the country.
Overinvestment.
Overinvestment.
So as an investor, then, what do you do? How do you sort of hedge against that or defend against that scenario that you're painting?
Our job is not to run the economy, thank goodness. It's merely to run a fund. So what we have to do is decide how patient to be with certain portions of the, of the U.S. economy. And bear in mind that equity markets like overinvestment. At least they like it on the way up. There was no real signal from the energy sector, for instance, this time last year, that things were going to look like they do today. You had to really pay attention to some of the supply metrics, and I think you're going to see that sort of play out. I also think that it's this year you've done a lot better looking at markets outside of the United States. I don't think the U.S. equity market's going to be a terrible place to be, but I think people really have been surprised at the ease of making money outside of the United States. Even parts of the world like Asia, which people have really been very negative about, have actually been a great place to be this year.
Well, and you've been talking about Europe for a while, if I recall, also.
Yeah, I think Europe's
now... Are you sticking with Europe?
Well, I think Europe is now fully recognized. 3 years ago, 2 years ago, you had to really fight to get people to pay attention. But the only attention that China gets is that it's a bubble. And Japan, people have kind of really been very quiet about a market which actually has given you the best year-to-date U.S. dollar returns of any developed market. It gets no attention whatsoever. So, you know, you try and look at good stories which people are not paying enough attention to on the long side.
Let's talk about developing markets then.
Yep.
When the Fed does raise rates, what's going to be the effect on the emerging markets?
I think it really depends not just on the Fed, but also what China's doing. There are two dominant sources of liquidity for the emerging market complex. There's the Federal Reserve and the PBOC. They don't quite match. There are certain countries which are much more dependent. This hemisphere, the Western Hemisphere, tends to be more dependent on Fed liquidity. Asian emerging markets much more on PBOC liquidity. And what's fascinating about this particular cycle is the Fed is poised to start tightening at a modest pace, right at the point that the PBOC is really starting to cut quite aggressively. You saw that last night with the reserve cut. I think you'll see interest rate cuts going forward. So I think the EM complex is going to have a benign influence from Chinese liquidity and a negative influence from Fed liquidity. And to an extent, they'll cancel each other out.
Michael, thank you so much for joining us.
Thank you.
And thanks for joining the Glasses Club, by the way. We all have terrible eyesight here, apparently.
I was first.
What did you say, Julie?
I think you need your prescription switch, Bob.
Oh, I'm wearing them. I couldn't, I
and
shouldn't
terrible
do
jokes,
shtick.
too.
Yeah, yeah.
Okay, all right. Michael Shaoul,
Nothing to do for that.
CEO of Marketfield Asset Management.